In September of 1998, the president of the New York Federal Reserve picked up the phone and called the CEOs of the 14 largest banks in the world. The message was simple. You have until tomorrow morning to agree to a bailout. If you don't, the global financial system may not open on Monday. The fund that had caused this emergency was not a bank. It was not a government. It was not even particularly large compared to the giants of Wall Street. It was a single hedge fund with $125 billion in assets. Its name was Long-Term Capital Management. Its partners included two men who had just won the Nobel Prize in economics. Its models had been described by some as the closest thing to a risk-free money machine that finance had ever produced. And in the span of roughly 6 weeks, it had lost nearly all of its value. Not because of fraud, not because of stupidity, but because the most mathematically sophisticated fund on Earth had made one foundational error. It assumed that the future would behave like the past. This is the story of LTCM. It is a story about genius and arrogance, about the difference between a model of reality and reality itself, about what happens when the people who are supposed to protect us from risk turn out to be the greatest source of it. And it is a story with a lesson that Wall Street has now forgotten 3 times and has never actually learned. To understand what happened, you first have to understand what LTCM was. John Meriwether had been the head of the bond arbitrage desk at Salomon Brothers, which, in the 1980s, was the most profitable trading desk on Wall Street. He was not just a trader, he was the trader, the man who became a legend in the bond markets. In 1994, after a scandal at Salomon forced him out, Meriwether started his own fund. He recruited almost everyone he could want: Robert Merton, Myron, the two men who had turned options pricing into a science. They would win the Nobel Prize in economics in October of 1997, while they were active partners at LTCM. He recruited former Vice Chairman of the Federal Reserve David Mullins. He recruited the best quantitative analysts from the top banks. The founding pitch to investors was essentially, "We have solved the problem of risk." Their strategy was convergence arbitrage. Find pairs of financial instruments that should theoretically be priced the same, but currently are not. Bet that they will converge. Repeat at massive scale. The models told them, with extraordinary precision, how much they could lose on any given trade. The models told them they were safe. In the first year, LTCM returned 40% to investors. In the second, 41%. In the third, 17%. By 1997, it had $200 billion in assets under management and $4.7 billion in equity. Banks fell over themselves to lend it money. Every major financial institution on the planet had exposure to LTCM. And there was something else, something the partners themselves didn't fully appreciate. Because LTCM's positions were so large, because it had borrowed so heavily to amplify its bets, it had become, quietly and without anyone quite noticing, a systemic risk to the global financial system. It had become too big to fail. Before anyone had ever used that phrase. The Black-Scholes Merton model is one of the most important intellectual contributions in the history of finance. It gave the world a way to price options, financial contracts that give you the right to buy or sell something at a fixed price at a future date. Before Black-Scholes, pricing an option was essentially a guess. After Black-Scholes, it became a calculation. The formula was elegant. It was mathematically beautiful. It worked. But it was built on assumptions. It assumed that market movements follow a normal distribution, the famous bell curve. Most moves are small, large moves are rare, catastrophic moves are so rare they can essentially be ignored. It assumed liquidity, that you could always find a buyer or seller at a reasonable price. It assumed that past volatility was a reliable guide to future volatility. These assumptions are reasonable. In normal times, they hold. In normal times, the models worked brilliantly. But markets are not always normal. There is a concept in statistics called fat tails. the idea that extreme events happen more often than the normal distribution predicts. Nassim Taleb would later call these black swan events. LTCM's models essentially treated tail risk as noise, as statistical irrelevance. The partners were not stupid. They knew the models were simplifications. But when you are generating 30 to 40% returns year after year, and every major bank on earth is lending you money at favorable rates, and two of your partners have just won the Nobel Prize for the very models you're using, it becomes very hard to remember that a model is not the same as reality. And then, in the summer of 1998, reality stopped behaving like the model. It started in Asia. The Asian financial crisis of 1997 had already rattled markets. LTCM had survived it. The models had held. But then, on August 17, 1998, Russia announced it was defaulting on its sovereign debt and devaluing the ruble. This was, by any historical measure, an extreme and unusual event. The kind of thing the models said wasn't supposed to happen. When Russia defaulted, investors panicked. And when investors panic, they do one thing. They flee to safety. They sell everything risky. They buy U.S. Treasury bonds. This is what economists call a flight to quality. Under normal conditions, the interest rates on U.S. Treasuries and slightly less safe government bonds converge over time. That convergence was exactly what LTCM was betting on. But in a panic, they don't converge. They diverge dramatically. In a panic, the difference between a safe asset and a slightly less safe asset becomes enormous. Because fear is not rational. Fear is extreme. LTCM's models had not accounted for this. Or rather, they had assigned it a probability so small that it was effectively treated as impossible. A 7 sigma event, something that should happen once in the lifetime of the universe. It happened in a single month. In August 1998 alone, LTCM lost $1.8 billion. In September, losses accelerated. The fund had borrowed so heavily, its leverage ratio had grown to 25 to 1, then higher, that each move in the wrong direction amplified catastrophically. And here was the worst part. Because LTCM was so large, its very attempt to unwind its positions made things worse. Every time it tried to sell something to raise cash, it was selling into a market that was already panicking. Its sales pushed prices down further, which triggered more losses, which forced more sales. The doom loop. By mid-September, LTCM had lost over $4 billion. Its equity had fallen from $4.7 billion to less than $600 million. Its positions represented notional exposure of over $1 trillion. $1 trillion. The Federal Reserve began making calls. What they found alarmed them. Every major bank on earth, Goldman Sachs, Merrill Lynch, JP Morgan, Deutsche Bank, Barclays, had LTCM exposure. If LTCM was forced into a fire sale, the resulting price collapse would hit every one of them simultaneously. It wouldn't be LTCM failing. It would be the global financial system failing. The Fed did not bail out LTCM with taxpayer money. This is important to say. What Fed President William McDonough did was convene a meeting. He gathered the bankers. He explained the situation. And he made clear that it would be in everyone's interest to find a private solution. 14 banks agreed to inject $3.6 billion in exchange for 90% of LTCM's equity. The partners were essentially wiped out but avoided criminal liability. The fund was slowly wound down over the following year. The crisis passed. The global financial system did not collapse. But the story doesn't end there, because the mathematical models that caused the crisis continued to be used, with small modifications, with lessons supposedly learned. 10 years later, in 2008, those same models, applied at even larger scale with even greater leverage in mortgage-backed securities, produced the greatest financial crisis since the Great Depression. The lesson was not learned. The story of LTCM is not a story about criminals. It is a story about a very specific kind of intellectual error, the error of mistaking a model for the territory. The Black-Scholes formula is brilliant. The arbitrage strategies were brilliant. The partners were genuinely among the most intelligent people in finance. But intelligence, deployed without humility, becomes dangerous. The models assumed that the future would look like the past, but the past had never included a world where LTCM itself existed, where a single fund was so dominant that its own behavior changed market dynamics. The model couldn't account for itself. There is a term for this in complexity theory: reflexivity, the idea that observers change what they observe, that markets are not natural phenomena operating according to fixed laws. They are human constructions, responding to human fears and hopes and errors in real time. No model captures that, not fully, not yet. The people who understood this most clearly were not the Nobel laureates. They were the old traders, the ones who had lived through enough history to know that extreme events are not anomalies. They are inevitable. Markets always, eventually, go to places the models say are impossible. Like this video if the story surprised you, and subscribe. We cover financial history that textbooks are afraid to tell.